Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with George Economou. How you doing today, George?
Hello, Kirk. Nice to meet you. I thank you for having me here.
Yeah. So George, tell us a bit about your background. Why don't you
Well,
bring in
yes.
George to talk, and he's got some pretty interesting background. So tell us a little bit about that.
Thank you. So I'm an economist based in Greece. I hold a PhD in macroeconomics and finance, backed by a master's degree in banking and finance. I'm a business, financial, and investment consultant for both businesses and individuals. And I also teach in universities, and I also have one YouTube channel, economics education channel that you can find under my name.
Okay. Cool. So there's a lot going on in the world right now, George. As you might have guessed, it's a great time to be a macroeconomist and a terrible time at the same time. So, why don't you give us just kind of before we kind of dive in, maybe you can give us your high level view of what's going on in the world.
Interesting things happen, and I have to agree with you. It's both an exciting and a terrible time because you cannot imagine the amount of work that we have to pull out. So, what we see right now in the world is the rise of economic uncertainty, economic and political uncertainty. I mean that you can see every day tariff percentages change. 2 or 3 days ago, we had again a new announcement about 100% more tariff on China from President Trump. Also, what you see is in Southeastern Asia that doesn't seem to care that much about that because, they have created the BRICS countries and they can work on their own. They seem that they don't need America and Europe anymore. And also, you can see Europe, which I think that they are lost, Kirk. They are really lost in the way. And I feel, that we might see things again, things from the very near past, from 2007, 2008, especially in the European Union.
Yeah, there's a lot all over the world going on from China, the EU, and the US, and everyone's got their own interesting things going on. And in some ways, it makes it very difficult to tease out what's actually going on and what's important, right? I mean, the Russia invaded Ukraine, and the markets went down for a few days, and then they went back, and they're even higher. And Europe is doing really well, even though they got a lot of problems. So it makes me wondering, like, what are some of the underlying fundamentals that actually drive markets right now? Because it used to be where things make logical sense, and now it seems like there's other factors driving the market. So I don't know if you can speak to those a little bit.
Well, I must split the markets in 3 or 4 sections in order to have a complete analysis. So the first market that I'm going to discuss about is the American stock market. Or generally the stock market, actually, it should be better. So you know that the stock market is driven mostly by companies' profitability. As companies' profits grow, so does their share prices grow, because these profits can also be used to expand their production, so gain more profits and give back to the investors greater dividends, and so on and so forth. What happens right now is that we have a very big boom in the artificial intelligence sector and the technological sector generally. So we have a huge driver of a growth from this sector. But the problem is that there is also another driver. And this driver is money. Money that people, that investors, even small investors or the big sharks, the Wall Street. They have money, and this money can also drive growth. So this happens all across the world. Now, what we see in the American stock market is that people seem to consider sorry, houses, house prices a little bit inflated. So they invest more and more in the stock market. Also, there is another driver in the American stock exchange, which is the monetary policy. When interest rates uh, get lower, then stock prices get higher. And this is because investors stop investing in bonds or in certificates of deposits. They prefer the stock market for the greater gains that it will hold. Now, what happens in the European Union and the Eurozone is that you can see a DAX index which is climbing. And I think that this is happening only because there are many stock buybacks from the side of the companies. This is something that I keep an eye on. So every time these numbers are announced from the side of the committees like the SEC, the German SEC, I like to see the numbers of stocks that were bought back by companies. And, this happens because CEOs and CFOs are paid from the shareholders. And what the shareholders want is to see a greater price on the stock they hold. Now, let's go a little bit to the UK. In the UK, we have probably an underlying economic crisis, a huge inflation, especially compared to the Bank of England's 2% target. But we see also that interest rates fall there as well. So again, falling interest rates mean greater stock. And the fourth pillar that we should discuss is what's happening in gold prices. You see gold prices soaring. They're skyrocketing. They are skyrocketing. Why? First, because there is uncertainty. The greatest driver of gold prices is uncertainty. Investors hate uncertainty and they go to safe havens, let's say, which are mostly precious metals. The other thing is that central banks, especially in BRICS countries, are piling up gold more and more. And also other central banks are buying gold as well, because probably they fear for a potential crisis. But you can see that we have two contradicting facts here: skyrocketing gold prices and skyrocketing stocks prices. So from one side, you see that people believe in the stock market, but from the other side, you see that people, investors, fear something. And I cannot quite get it, how it's done, how this is even possible.
Yeah, it's I think there's a lot of areas, I mean the gold price especially, that it it makes sense because it's going in the direction that people have been talking about for a long time, and the uncertainty is certainly there. But where was the uncertainty last year, the year before? I think the uncertainty was still there. It's just, um, I think things happen in chunks, and gold and silver seem to be happening now at a very fast clip. It's so much so that it makes me wonder why. Why now? Like, what's different? I mean, Trump was president 4 years ago, and it didn't do what it's doing now. I would say there was more uncertainty the first time because no one had any idea what to expect. Now, at least they know to expect the taco trade and all these other things that Trump does. So why is uncertainty greater now with gold and silver and precious metals than it was before last year or even during Trump's first term?
Look, I think that we have to discuss a little bit about geopolitics here and not about economics. So for many, many years, the world was running mostly unipolar. The only polar of power was the United States. Then came EU. After the GFC, we see that a multipolar world is being created. And we can also see that conflicts, wars, to speak clearly, are more frequent now than they were in the past, and they happen in places which are very, very important for the international economy and trade. You could see what was happening when the conflict between Israel and Iran took place. There was a huge fear for an upcoming closure in the Hormuz Strait, and you could see oil prices skyrocketing, along, of course, with gold prices. Then you have another war in Israel, in Middle East, and you don't know still what will happen there. You don't know if Iran will engage again. You don't know what will happen between Saudi Arabia and Yemen. Um, Also, there is the Russian thing, because I think it's not a Russia-Ukrainian conflict anymore. You see that Russia um invades the airspace of European Union, European zone countries, NATO airspace, and this creates fear. What I think about that is that probably Russia tests the response times. They don't seem to want to do something special there with very bad quality drones. But I think that they test response times and they create a game. A game meaning a game from the game theory. So they test not only the response times, but also what might be the actual response of NATO and European countries. So all these conflicts that's happening all around, and of course we have to discuss about what's happening between China, Taiwan, and the USA. This is another not active field of war, but a source of anxiety. So I think that these might be the factors this time that drive gold prices up in the air.
Yeah, I mean, I think that's good insight. What do you think of everyone's got an opinion on tariffs? What do you think about tariffs? I think in general, people just knee jerk to, oh, tariffs are bad because they were bad 100 years ago. Um, but, you know, they don't seem to be creating huge harm in the US right now, even though who knows what will happen 6, 12 months from now. But
Mhm, mhm.
how do you perceive what the US is doing for tariffs? And, how do you think that'll play out?
Look, I have two opinions in that area because every coin has two sides. Of course, USA experienced tariffs again in a very bad way. The outcome was not a very good one. But we have to discuss about the Nobel Prize now, the Nobel Prize that was announced some days ago in economics. So, in order to promote economic growth, in order to promote sustainable economic growth, you need an open economy that innovates. An open economy that innovates means an economy that can accept products from other places. Tariffs, for the reason that they are implemented are good. Of course, Donald Trump has very good reasons to implement tariffs. The very good reasons are to keep industrial and technological production inside the United States. But it was also Republicans that pushed technological production outside of the United States. Okay, so he tries to change bad things, bad decisions that were made in the past. But to be honest, were they bad decisions? I mean, United States has a very high production cost because mostly of the salaries. And also, if we discuss about technological phones, technological products, take for example mobile phones. Take an iPhone, for example. This is produced in China, and it is produced in China for a very important reason because of silicon, because of chips. They are the rare earths and silicon and rare earths like lithium for batteries can be found in vast amounts in that area. And it will be cheaper to produce them there than import rare earths and silicon to the United States. Now, if they will be successful or not, time will decide. But statistics and economic models and theory suggest that it will be probably not a very successful action.
Yeah. Okay. What are your thoughts on AI? A lot of money has been spent on AI, and frankly, I a lot of CEOs have been saying how they're not seeing any increased productivity and it's not paying off, but yet large amounts of money are being spent there. So, what are your thoughts on AI?
Mhm. Okay, now you open two different topics though. One is that they don't that CEOs don't see productivity, and the other one is the money spent. So let me discuss the second first, and I'm gonna visit the first one later. So many money are spent because AI is new technology. Imagine smartphones. How much money was spent in smartphone production and R&D during 2006, 7, 8, 9, 10, the very first years that smartphones were launched? Billions, many billions. Now, of course, AI is a little bit more resource intensive because of the chipsets that you need to buy. And of course, these chips are a little bit more expensive. But AI will definitely help in many things. Take, for example, diagnostics, medicine, genomics. You can use AI to find new drugs. You can use AI to discover cancer before it even can be seen from the human eye. Um, Probably you might sometimes, you as Kirk, might sometimes find discussion topics using AI. You might have used ChatGPT to find some good questions or good topics. I have used AI when my mind was blank and I couldn't think of a topic that I should discuss on YouTube. So, oh, sorry, and another one, the data science and programming. AI has made huge steps in these areas. I mean, I can put a large Excel file, large data set, and I can have excellent results in several minutes when I was required to spend several hours and almost destroy my graphics card. Uh, I can write, or actually, AI can write a code for me that I order it. So, hello GPT, I want a code that will do this and this and this and this. And if this happens, I can even use booleans, and it's a time saver for me personally. Now, and of course we have huge road ahead to drive. Now, for what you said, that CEOs do not see any productivity increase. Well, I will tell you that. Right now that I'm in China and I discuss with people, they tell me that in Shenzhen and Shanghai, the unemployment is rising because of layoffs due to AI. So it seems to me that AI right now is created to not supplement but change the mix of employment. So I employ 5 robots and 5 humans instead of 500 humans. It works as a substitute. And maybe this is the reason that they don't see a productivity increase. Now, in my consulting agency, we have a program to help businesses implement strategically AI so that they can both see an increase in productivity and also a huge decrease in their costs.
Okay. Um, Now, what are your thoughts on valuations globally? The US has been very extreme on the valuation side. It's as expensive as it's ever been, even since the internet, but it keeps going higher. And
Mhm.
so, what are your thoughts on why that's the case? And do you think that's going to continue?
I think that the case again is that investors don't want to spend their money in something else than stocks and gold, probably. They don't want to spend money in bonds because they become cheaper. They don't want to spend money in houses because they become more expensive, and they don't know for how long these house prices will be sustained for. Now, of course, the valuations are extremely high. So you need about 25 to 30 years for break even, and this is quite a long time. Now, if these levels of prices can be sustained for long enough, I don't think so. And I don't think so because, as also an investor, when I think that something is very, very expensive, I will stop buying it. And if there are no buyers in the market, then prices will go down to the floor. I don't want to be, the doomsday prophet. I don't want to scare people. This is just my opinion. But I think that I have given some logical arguments about this opinion.
Cool. Well, we're going to wrap it up here, George. Final thoughts, and where can people find more about you?
Well, people can find me under my name, George Economou, as I spell it. They can find me on YouTube, on my website, geo-economou.com, and they can also find there my newsletter.
Awesome. Well, thanks for coming on, George. Really appreciate your time, and yeah, we'll talk to you in the future.
Thanks again for having me, Kirk. Goodbye.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with George. Really appreciate him coming on the show. Now we're into the panel portion of the show. We have our very own Diana Perkins. Hey, Diana.
Hi, Kirk. Thanks for having me on.
Yeah, thanks for coming. And we also have Barb Freeberg. Hey, Barb.
Hi, good to be here today.
Yeah, glad to have you both. Well, let's dive right in. So, Diana, what are some of your takeaways from the interview?
Yeah, so for me, there are really two things that stood out. The first is the disconnect that we're seeing between uncertainty in the macro environment, economic, political, and the very bullish price action that we're seeing in the stock markets. The second is really that gap between current AI productivity from the business owner's point of view and the market's belief in future productivity. So on the AI front, the way I see it is the real gain isn't simply a reduction in workforce, as was mentioned during the interview as an observation, but the real value is what I call human plus machine. So essentially upskilling workers to work with AI. The markets are forward looking, so the price is reflecting anticipated productivity, not what's already been realized, because there's time to get to that point. And then on the valuations, yes, they are extended. I know on this panel there'll be lots of opinions around this as finance folks and wealth managers. So I agree they're extended, but extensions can last. We've seen that in the markets. And as a trader, I focus on like less on calling the tops in the market. I mean, timing the market's one of the hardest things to do, and more so around the risk management aspect and letting price either confirm or disconfirm the narrative. And that's how you navigate a market that looks expensive but still has momentum. So both themes, same idea in this environment. You hear me say this time and time again, trade the market in front of you, not the one that you think should exist.
Yeah, I couldn't agree more. Barb, what about you? What are some of your takeaways?
Well, macroeconomics is obviously a really important topic, as is the high valuations in the market. But the question for you and me is, what does it matter to us, to our investments? How is this going to impact my portfolio in the future? And don't turn off now. Listen till the very end. But what I'm going to say is this time is really not the same as a lot of times in the past. And so I believe we are treading in uncharted waters. Yeah, there have been tariffs in the past, and we would expect that to really hurt the economy. Now, it's hurting some businesses, obviously. Farmers are just dying, and many small business owners are closing because they can't get their materials at affordable prices. But overall, the market's not tanking because there are tariffs. And then you have AI, and many people are saying, well, AI is kind of like the 2000s or the 1990s, when the internet was booming and all these new companies were coming in. And we know what happened in 2000, the market totally took a dive. But we just don't know what's going to happen this time. And so stay tuned so we can talk about it and see ideas on what you can do today. Diana is a trader. I am not. And so you get a lot of different viewpoints.
Well, I'm scared now because I thought I heard her say, this time is different. She didn't say those, but I think that's what she meant. This time is different. And every time I hear that, it's usually the top of the markets for when anyone says this time's different. So that's a good marker, Barb. I appreciate you mentioned that because you've been around for a while. You know the markets.
I know. I am like, really, when people talk about the 1960s, it's like, yeah, I was alive then.
Well, you have to tell me about that someday, Barb, because those sounded like interesting times.
Yes,
Um,
I'll give you the real picture.
well, so what's interesting is, and I want to bring that perspective to that comment about this time is different because I think anytime you see a new trend, people always come out with the term "this time is different," like it's going to be different this time, um, and while you could say that about AI, you could say that about the internet, and because the technology, I think in AI, if AI becomes AGI, then I would say this time is different because that is a very different thing. You're basically creating life um, in a synthetic form, so that would be very different. But withstanding that, which I think we're, from what I read it, like 20 years away at the earliest, assuming they can do it, or assuming they want to do it, they want to let it out. Um, but withstanding that, I think the thing that is different that I think people should keep in mind is the structure of the financial system. It's not the trends, it's not the investments, it's the structure that I think is different this time. And the structure being different is what a lot of people are calling the relentless bid. The relentless bid is effectively a lot of this passive money that keeps flooding into the markets, these indexers that keep putting money into the markets and keeps buoying stock prices. I mean, a good example, I think the last quote unquote crash that we might see withstanding a very existential event was 2008. Because look at COVID. During COVID, the whole global economy shut down and the markets were down, what, 33, 35%? In what world is that rational? I mean, the market should have been down 90%. They were down like 35% when the whole global economy was shut down. Not just a sector, the whole global economy. So in what world can you ever see a 50% sell-off again? And I'm not saying we won't, but I'm just saying that the structure is broken in maybe a positive way, sort of positive in the way that, like, yeah, things are really bad, but the markets aren't going to really break. So I guess that's positive, although it's not positive because it's not a real free economy. It's a managed economy. So I think from my perspective, the macro it makes macro investing very hard when you can't make reality turn into a result when it comes to investing. It just seems like no matter what you do, everything just keeps going up. That I think is a challenge. I mean, Diane, I know you do more trading than fundamentals, but how do you see valuations kind of playing into things? Like, what do you care? Like, what do you think is going to happen there? Because we've been out of sorts with valuations for quite some time.
Yeah, no, I appreciate that question. And I mean, my background CPA, it is fundamental, but you're right. When it comes to the markets, I'm looking at price action volume, primary indicators. I will look at different catalysts, whether they're macro. So later today, we have a Fed rate decision, all eyes on that. I'll look at earnings before I get into a trade. Is something going to break the trend? But primarily, my mantra is trade the markets in front of you. I think it's important to focus on what you can control because you're right. There, initially, back in April of this year, when reciprocal tariffs were introduced, we saw a huge drop, over 20% in the broad market. And since then, we're seeing less of a broad market based change or reaction, and it's more sector focused, specific stock focused, and you see it almost calming that reaction. So you can't always look at these macro events and use it to predict what the stock markets will do. I mean, one thing that came up in the interview that I thought was interesting is that almost tension between what we've seen in commodities, kind of the safe haven we call it, right? There are definitely sectors and areas of investments that are risk on and risk off. And then, but we see this continued rise in the broader stock market. So to me, that tells me that the money flow, it's not exiting, it's just rotating. And as a trader, I look at the different sectors and see where the money is flowing into. Is it the higher risk areas like technology, like discretionary cyclicals? Is it like consumer staples where folks tend to invest in when there is greater uncertainty? So the best thing that we can do is trade, invest what's in front of us, and let the market tell us where that money flow is going next.
Yeah, it's a good thoughts. Barb, what about you? You're a fundamental gal. What are your thoughts on valuations and how does that play into your investing decisions?
Well, I keep thinking of the black swan. Talib wrote a book, a decade or so ago that talked about black swan events. And those are the events you cannot predict. And those are the huge events that will make a difference. And yeah, valuations are high. They were really high. And I am going to disagree with you from the interview. You said they're at the highest levels ever. I believe they were higher at the end of 1999. But that said, valuations in the US are extraordinarily high. But when you listen to a lot of different analysts, they're saying, and again, don't kill me for this, but you know, the productivity is expanding. AI is making quantitatively our business environment different. And another point being that valuations can stay really, really high for a really, really long time. Now, I know for a fact, and you can, dispute me or whatever. I know for a fact we will have a crash because markets do not stay high forever. They never have, they never will. But here's the rub. We don't know when. So, like Diana said, like every investor knows who's been in the markets for a while, you cannot time the markets. It is absolutely impossible. So, maybe somebody will get lucky and do it, but very unlikely. So, what do? US valuations are high. International valuations are not as high. And so I'd say if you don't have any international holdings, put some stock holdings into your portfolio. Now, Kirk, you said in the interview, and I agree with you, but the problem is, where else are you going to put your money? We're looking at dropping interest rates, so you don't get anything on your cash. Bonds have been very questionable over the last 15 years. That said, I do hold some bonds, but where are you going to put your money if you want returns? So, long story short, it's really a conundrum for investors. And what I'd like to kind of close this rant with is, you're not going to time the markets. Eventually, businesses are going to continue to grow. They might have a short-term pullback or even a longer-term pullback, but with monies that you need for retirement, not for next year when you're buying a new house or sending your kid to college, you've got to have some money in the stock market. It's just, it's the best way to grow your wealth long term. And so be prepared that you're going to have a pullback. Don't sell after a pullback, but long term for your 7, 10, 20, 30, 40-year monies, the stock market still does not have much of an equal. And sorry about this, but I just have to throw in one other thing. I was reading the Wall Street Journal this morning, and they were projecting Bitcoin pricing. And I'm not sure who it was, but an analyst has halved their projection. They had it at 200 coming up. Now they dropped it to 100. So what does that mean? Well, it means we don't freaking know what's going to happen with Bitcoin. So if you're going to be invested in Bitcoin, realize you are in speculative territory because it's not backed by anything.
I just want to point out a funny thing I saw on X yesterday, and it showed a list of all Wall Street's projections for Bitcoin. It was like 250,000, like 750,000, like 200,000, and the comment was, people who thought it would go to zero have a closer prediction to where it is at the end of the year than every Wall Street analyst. It's like, I mean, it's just hilarious how wrong these people are. But you're right, Barb. I do want to say I find it amusing that Wall Street always has their acronyms, right? It's FANG stocks. I forget what it was before that. The Mag 7. Then there was TINA, right? There is no alternative. Now it's taco trade. Trump always chickens out. If you haven't heard of that, that's a big thing on in Wall Street. So, Diana, what are some of your thoughts? I mean, there's Trump's doing a lot of negotiations, there's a lot of tariff talks. It's been a little silent lately, but how do you think all that plays in? Are there opportunities there, or should people just kind of ignore it as a headline, thing that they don't have to worry about?
Yeah, this is a great question. I love that you brought up the taco trade, because I think it's hilarious. So, first of all, I mean, tariffs create noise. I mean, there's no doubt about it. I feel like that's a theme of the year. Maybe the theme of the year is around tariffs and what's going to happen. And I do believe that long term, we will see, we've already seen effects and implications on supply chain. So those pieces are real, what we're seeing in the markets and what companies are experiencing as a result of these policies. But what's interesting is I feel in the near term that the markets are less focused on the policy itself and more so on whether it changes earnings estimates and I'll say sector leadership, depending on where the policy affects. And you'll see some knee-jerk reactions to that, and then you'll see a commensurate reaction, so similar to the taco trade, oftentimes in the market. And a lot of times it is reactionary, especially if it is shorter term. So as I mentioned, back in April, we saw that broader based reaction to tariffs are really, I mean, almost like bear market territory, more than 20%, which is unusual. I mean, correction territory, 10% every 1 or 2 years. But for a 20% drop like that, I mean, that's significant. But now we see less and less of a reaction. So for me personally, in my trading or my longer term investing, yes, I do a little bit of buy and hold. But regardless, I'm always focused on the leaders and I'm focusing on managing my risk around the edges, which means when there are those reactions, I may reduce my position sizing. I may tighten up my stop losses. I tell my traders it's just as important to know when to stay out of the markets as it is when to be involved in the markets, which I know is really hard for some people. But again, if it is, that means it's your, psychology or your emotions reacting and not logic.
Yeah, no, I appreciate that. So, Barb, what are some of your thoughts about all this? I mean, I know I'm more actually a little bit curious about your thoughts on housing too, because you're a real estate gal, and the housing market's been confusing me for quite some time, and I think from a macro perspective, it matters because that's where a lot of Americans' wealth is tied up. But if we keep dropping rates, it feels like a lot of these boomers are going to start selling their houses because they can swap out for cheaper houses, and that might bring on more inventory, which might actually bring down that cost of housing, oddly enough. What are some of your thoughts? Where do you think housing's going in real estate?
I'm glad you asked me this because I was just looking at the housing market last night. And it was one of the articles that I read, again from the Wall Street Journal, was profiling a neighborhood north of Detroit where the median house price was $1.5 million. Now, in California, that's like, oh, no big deal. In Michigan, that's a big deal. I was looking at these houses, 4, 3, $5 million houses in Michigan. Then I hopped on over to my local real estate app and I was checking the pricing in my neighborhood, which again is in Silicon Valley. And in case you don't know, prices are really, really expensive in this region. And lo and behold, they are holding up and going up, even with the prior rise in um, interest rates. Now, rates are going to fall, but you would expect if mortgage rates went from 2.5% to 6% over a short period of time, you would expect prices to fall precipitously. They did not. Now, time on the market did increase. And again, real estate is regional, so it depends where you live. But I don't know how young people are going to get into the market unless there is some type of turnaround in the housing markets. Because in general, housing continues to appreciate at a pretty good rate. And for many, many people, it is unaffordable. Um, We've talked about this a lot on the show. And I do also want to switch to another macro real estate issue, which is commercial office buildings. They are being slammed with the remote work environment, with the follow-up to the COVID work at home scenario. And just in San Francisco, one of the biggest realtors in the area is pulling out. They own a huge percentage of commercial real estate and they're taking their offices away. We have so many commercial and companies in California moving to Texas where it's cheap or moving to other places. And that commercial real estate is creating a real dearth, a real lack of, you know, a lot of vacancies within the big cities. Let me just put it that way. So I think we're in an inflection point in commercial real estate. They're converting a lot of that to residential, which I think is a really cool idea. Housing, again, another inflection point. Something has to happen if the majority of our younger people are going to be able to afford a house. So I hate to say this, Kirk, Diana, I almost feel like there's more questions than answers now. And the only thing I can suggest to people is for the housing market, build up cash. Keep that stash of cash so you can save up a down payment if you want to buy a house.
Yeah, that's great advice. I mean, I think this always comes back to the comment that I read in I forget what it's called, but there's a book by I think it was Harry Brown in the '70s talking about the coming devaluation. This is back then, and one of the comments he made was the one thing that was a lot of people didn't know what was going on. Like mass confusion was the sentiment for that period. Like people didn't understand what was going on in the markets, and stagflation wasn't a term that had been used before, but people hadn't experienced it, and it feels much like right now there's mass confusion about what's going on. Real estate doesn't make sense. The stock market doesn't make sense. Like none of this stuff makes any sense. It's just it's happening, and it doesn't happen logically. And I think it's really hard um, to put your finger on like why is this happening, and so that any of it makes sense. And it just forces you to just follow the momentum, unfortunately. But yeah, I like your thoughts. I mean, real estate's just one of these confusing things that people I've talked to just say it's the bottom's not in yet, but we've definitely taken a lot of a lot of wind out of the sails, but it still needs to be cleared out. And so that to me is very interesting in the space. I have no interest in commercial, but I would imagine if I did, now would be a time to start looking. You could probably find some pretty good deals. And probably find better deals along the way too. But anyway, so we're gonna wrap it up in the interest of time here. So final thoughts, Diana.
Sure. So for me, the bottom line, it's twofold. So one, uncertainty is elevated, valuations are stretched. We talked about that, but the market is still choosing leadership. So Kirk, you mentioned momentum, agree with that. So my advice is instead of trying to forecast every macro inflection point, which we can't control, and there are a lot of them, both domestically and international, I think investors are better served by focusing on what's actually working, managing risk around the edges, as I mentioned before, and trading the markets in front of them. One thing I'll add as well is I know we talked about timing the markets and whether it's the housing market, the financial markets, like the stock markets, bond markets. There is one logical principle that we can apply in times of uncertainty, and that is the concept around reversion to the mean. I know traders understand that from technical analysis, but essentially, when we do see overextensions from long-term averages, like a housing bubble, the internet bubble in the late 90s, eventually we do see a reversion back to those averages. Now, we don't know when, but that's something that we can look for. Like I said before, the markets will tell you what they're going to do next. We just have to pay attention and not try to trade what we think it should be. We've seen bull markets in the past, 9 years plus. Every year you'll go on CNBC, Chicken Little, the sky is falling, the sky is falling. And then it's another year, another year, another year, and then eventually it does revert. So something to keep in mind. I'm Diana Perkins. I'm founder and CEO of Trading with Diana, where I help professionals build wealth in the markets through trading and investing. You can learn more on my website at tradingwithdiana.com.
Awesome. Thanks for coming on, Diana. And Barb, final thoughts from you.
I loved that you mentioned, Diana, reversion to the mean, because that has proven for us fundamental investors to be a reality over the long term. So when we're talking about valuations, right now, valuations are very high. In order to revert to the mean, which means the averages. So the averages of 10 years of, and I just use the price earnings ratio because it's a very common metric and it's very easy to use both on individual stocks and also on overall markets like the S&P 500 and the world markets. We are at high valuations. That means at some point, and I would bet on this, okay? This is how certain I am. At some point, we will revert to a historical mean. And in order for that to happen, you're going to have to see one of two things: exponential, unbelievable growth in earnings, or a drop in stock prices. And so my final advice to you is just understand the markets, learn about market history, and be prepared for declines that will come. And steel yourself psychologically to not try and sell after a market decline, because you have to be right twice. You have to be right when to get out and then when to get back in. And that is notoriously difficult. Money that you need within the next few years, unless you're a trader like Diana, should not be in the markets. Actually, even if you are a trader, it shouldn't be in the markets. Just just use your long-term money for the markets. And your short-term money should be in safe assets like high-yield cash accounts or short-term bonds. I'm Barbara Friedberg. You can find me on YouTube and at my website, Barbara Friedberg Personal Finance. See you next time. Bye.
Great. Thanks for coming on, Barb, and thank you both. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.